Hello. Finally, we are here, our last managerial accounting class. We've learned quite a bit about managerial accounting, and we not only discussed cost components and what's their relationship and how to decide whether certain costs are up to expectation, better than expected, or fall short of expectation. And we also talk about making some decisions regarding performance evaluation. But today we're going to further discuss the role of managerial accounting in companies' decision making. Here we talk about decision making. We are not referring to performance evaluation or improvements anymore, but we are talking about utilize managerial accounting information to make decisions in specific, make or buy products for sale. That's the first we're going to talk about. Then we're going to talk about whether to accept or to reject a special order. And the last, we're going to another least important for sure. We're going to talk about whether to keep or drop a segment. So what's the background of these, right? So sometimes when companies sell products, we do see different kind of businesses. For example, we have Costco. Does Costco sell anything they make by themselves? No, they charge shelving fees, and they buy finished goods finished by other people and ready for sale already, and they put it on their shelf and online internet store and sell them. So they buy and they sell. And we do have other businesses. For example, if you think about companies like Dell, they make laptops, they make computers, and they sell them, right? So imagine a company always have to make decisions about these. That shall we, if we have sales, is it a good idea to buy and then sell to other people? Or is it a good idea to invest and make products and sell to other people? So what's the benefit if you think about it? What's the benefit of buy? If you just buy, then you don't have any fixed costs, with the exception of maybe some storage costs, but you don't have too much fixed costs. Everything is variable, and you pay certain money for each unit of product you want to sell, and you sell markup and you sell it. Straightforward. The disadvantage is, of course, compared to what you make. If you really make a lot compared to what you can make by making the products, the variable cost will be too high, will be much higher than you make it by yourself. So same here is that when you make, the variable costs might be low, but you have to deal with fixed costs. And the fixed costs, when the sales volume is quite low, the fixed costs per product can be very, very high. Only if you can make sure you will sell a lot, whatever you make yourself in-house, then it might be a better decision to make instead of selling. So we're going to talk about using managerial accounting information to make these decisions and how the cost components will involve and what costs we have to talk about. So talk about accept or reject a special order, right? It's the same sense. So what is a special order? Meaning that somebody put an order asking for your product. However, there are some specific needs for the special order. They may have price needs. They said, hey, look, you are doing retail. However, we're going to buy 10,000 units from you. So can you discount your price by maybe 20%, 25%? So the price they are paying for the special order will be different from other products they sell to the public. Or, for example, the special order says, hey, we are purchasing certain things for our company. So I want you to, in addition to the different price we require, we also want you to put our company logo on the product. So that's going to require additional cost as well. The cost will differ. So as a business, you have to think about, hey, shall we reject or accept the special order? Of course, in real world, you have to think about the long-term benefits. If we do this, even if we lose money for the company, we're going to have those business forever. So it might be good in reality. But in the books context, we don't think about too much about the long-term, but we focus on whether rejecting it or whether accepting it will bring us positive cash flow, which is a good thing. And the third topic, what is a keep and drop a segment? Let's refer to a case. I don't know how many people heard about the term. Now it's Mac and iMac and stuff, but how many people heard the term called ThinkPad? When I was in college, ThinkPad was the number one business laptop. It was very expensive, and it used to made by IBM. And who's making it now? Lenovo. What happened around 2008? Lenovo basically dropped it. Sorry, IBM dropped its PC business and dropped all the assets related to it, transferred the liability based on the deal to Lenovo as well, and then it gives all the business to Lenovo. Okay, and Lenovo took it over. So in this case, that's what we talk about, because PC was a segment of IBM. IBM is now mostly doing consulting business. But why IBM? How IBM justifying the reason to sell? The reasons to sell. One is that a consulting business is very light assets and they are more flexible, right? And they have much more profit margin from consulting. And the second, IBM did its calculation, right? So by although asset is transferred, but IBM also got rid of about I think a few hundred millions of debt. And then IBM calculated, okay, we got rid of that, receive money from selling the assets, and we will forego whatever the profit we have from running the PC business. Let's do our calculation, and they figure out it's much better to sell it to Lenovo, and then IBM made a decision. So sometimes companies make such decisions as well, right? They have to figure out, okay, by keeping a segment versus dropping a segment, what cost under different scenarios can we avoid, and how much revenue are we going to lose? And by doing this, they figure out whether it's better to keep or to drop a segment. And we're going to look at things in a more specific sense. And again, what costs do we have to consider? Some costs, not all the costs needs to be considered. Some costs may not be relevant to the decision, and we call them sunk costs. And what is an example of sunk cost? Right? So for example, you want to change your apartment. You're thinking about whether to change your apartment or not. But then you realize when you came in, when you first moved in, you spent $500, had somebody to make the bedroom, decorate the bedroom or the whole apartment in the way you want it. However, that's there already. It has nothing to do, because nowadays you pay rent, you do everything, and you want to figure out, because the $500 will never come back. So it's sunk. It's irrelevant to your decision making. On the other, right? So that's some sunk costs we have to think about. Not all the costs related to the events or items you think about might be relevant. Some are spent there already, so it's irrelevant. And the second, we call differentiate costs. It's quite easy to understand. Different decisions may be associated with when you're choosing between, for example, when you're choosing between make and buy. Make and buy will have different costs. Like you said, if you make, you will probably have lower variable costs, but higher fixed costs. When you choose to buy, you probably will have almost nothing or a little bit fixed costs, and you have high variable costs because other people make and they charge interest as well. So those costs, they are examples of differential costs. And then the third is called opportunity costs. Opportunity, what is opportunity cost? The benefits and income that will be foregone if you give up one alternative, right? The money you could have made, but you did not make because you make certain decision, is going to be the cost of that decision as well. For business, because businesses, they are supposed to make all the money they are supposed to make. So if you let one go, that's your cost, right? So for example, I'm thinking about, let's say, rejecting, I'm talking about realistic, I'm talking about rejecting a special order. If the company made a decision rejecting a special order for this year, sometimes in real world, they have to think about maybe for the years after this year, we will never get a special order from this company again. And then later, they might provide with better price. And if they will provide a better price based on the contracts, they said, okay, this year we buy from you, you can do whatever 50% off of your regular price. Years after that, you only have to do 10% off. So although this year is not good for you, but next 5 years, 10 years, it's going to be great for you. So if you are making accept versus reject a special order decision, and the contract is constructed like this, and if you have to realize, if you turn down reject the special order, you are also turning down the money you'll be making year after the current year. So that's called opportunity cost, because by choosing to reject, you are foregoing the potential revenue you'll receive in the future. Okay? And then we have the avoidable costs. It's quite understandable. You can avoid it. For example, in the Lenovo, in IBM sell PC business to Lenovo case, by getting rid of the debt, transferring the debt, they avoided what? Interest expense. right? And they avoided a lot of fixed expense as well by giving the whole package, right? So we have to know what has been avoided. If by choosing an alternative, the cost, some certain costs are avoided, then that's definitely a benefit of choosing that alternative. Okay. So explanation, theoretical explanations are weak. Let's take a look. So again, I make a few things that might be interesting. So if we talk about a make versus buy, right? What is cost to buy? Purchase cost and other costs associated with buy. For example, you might need large storage and you might have to transport it if by the contracts. And on the other hand, if you want to make the cost, you have to invest. You have to buy machine, whatever stuff, and there's production costs, and there's potential income from other opportunities if there is any. For example, if you choose to make, you can make more, and you can use the investment, the PPE, the machine to make some other stuff. If there are such cases, then you have to consider all these. Okay, so here we are just talking about costs, and you choose the one with the lower costs. And we may talk about accept or reject a special order. We are basically comparing two scenarios, right? One, when special order is rejected, nothing brings to us, no change at all, right? And the only thing is, if it comes with future year's contract, then that's gonna be the cost of rejecting the special order, all right? And then if we talk about accepting a special order, then we have to consider, okay, revenue from special order and additional cost for special order, like putting a logo and everything, and transportation stuff. So those need to be considered. And we are basically comparing with a special order and a no special order, which one is better for us. And we're gonna see I'm gonna do practices for each scenario. So we're gonna see what it means, what's the indication to us. And keep a segment, current segment revenue, and the current segment cost. Keep a segment meaning that's just the way it is, right? We can take a perspective for the whole business. The business currently it is with the segment, what's it going to be like? And we should know it already. And after the segment is dropped, hypothetically, if we have dropped the segment, what the business should be like? Okay, so we can compare revenue from segments or the revenue for the whole business without segments. And then we think about the cost avoided. That's going to be the benefit as well. And then we're going to think about gain loss on dropping the segment. If there's anything you have to pay other people, investment banks, whatever stuff. So that's going to be cost as well. Let's see some examples, and we can have some further discussion about it. So practice number one, fresh foods. A large restaurant chain needs data to determine if it would be cheaper to produce 5,000 units of its main food ingredients for use in the restaurants or to purchase them from an outside supplier for $12 each. Cost information on internal production includes the following. So direct material, total cost is you need to make 5,000, 25,000, direct labor, and variable manufacturing overhead, variable marketing overhead, and fixed plant overhead, all right? So fixed overhead will continue whether the ingredients is produced internally or externally. So keep them apart in mind. If you have, right, no additional cost of purchasing will be incurred beyond the purchase price. So the question is basically, which alternative is better? This company, they are making decision whether to make or buy. The price setting won't be affected at all. And they need to decide what to do with the 5,000 units they want, so they need, okay? So basically we are comparing make versus buy. Then let's put all the ingredients. So revenue is gonna be the same. No matter you make or buy, revenue is gonna be the same. So we don't have to consider revenue. All we have to figure out is which costs less. So let's just figure out the cost items, okay? So direct material, direct labor, variable overhead, manufacturing, fixed, okay, sorry, variable marketing overheads, and the fixed plant overheads. And then let's take a look and think rationally. Again, my answer may be different slightly from the book. The book is not the Bible, we have to understand. No matter who it is, everybody makes mistakes. It's printed in the book doesn't mean that it is 100% correct. So we have to be aware of that, okay? So let's see, let's check out everything, okay? And I'm gonna add one more thing here. Well, that's not, no, add it here. Purchase price, right? Purchase price is checked for the buy, all right, for the buy. So if we look at it, what we are seeing is the purchase price is gonna be 12 bucks, right? So at this moment, it seems pretty forward. Hey, if you make it, a unit cost of $17.50, and if you purchase, it's 12 bucks each. So at this moment, it seems to be no-brainer that you have to do it, but you have to pay attention to this. Is for there are some costs you cannot avoid, even if you choose to make it or to buy, right? You cannot avoid. So let's take a look. What is direct material cost? It's 5 bucks each. And the labor, 3 bucks each. And the manufacturing overhead, 1.5. And the variable manufacturing overhead, variable marketing overhead, 2 bucks. And the fixed plant overhead is gonna be $6. So I'm gonna, so total per unit, okay, cost is gonna be like, we knew this already. The answer should be 7.5, like stated here. Then if we choose to buy, what cost can we avoid? If you choose to buy, of course, material labor won't be there, right? What about variable overhead? Variable overhead can be avoided as well. Variable overhead can be avoided as well. And the only issue is we have fixed plant overhead and a variable marketing overhead. So let's first, it's quite clear. It says fixed overheads will continue whether ingredients are purchased or not, right? So here we gotta put 6 bucks there. And you know, it sort of changed the equation a little bit already. And then I actually have some political question about, because I saw the answer already. I have some particular question about variable marketing overhead. Because to me, no matter you buy, what is marketing for? Marketing is for other people to know your stuff, and so you can sell to other people, sell as much as possible, right? So I'll be straightforward with you. The book, according to the correct answer, I think the marketing cost could have been avoided as well. But in reality, I would hesitate to say so because no matter you make it in-house or buy, I think you still have to make sure you sell your stuff. So to me, the variable marketing overhead cannot be, cannot be avoided, right? So there are book answer, and here's by my answer. I'll just do the comparison. Like I said, I don't like to just take books explanation for granted, right? So using books method, if you purchase, you cannot run away from the fixed plant overhead. So it's going to be 18 bucks, which is 50 cents more than to buy than to make. And if you choose to buy, under my calculation, it's going to be 20 bucks plus a $2 variable marketing overhead, which I don't think people can avoid because you still need to do marketing to sell. So no matter which way we choose, it's still more expensive than making it, which costs $17.05, right? So if we take a look, here's a difference. Difference for this is going to be 50 cents. Oh, what am I doing? 50 cents, and for this is going to be, my calculation is going to be 2.5, right? And then units, oh, hate it. Units is 5,000. So what do we know? Okay, so each unit, if you do the book method, which uh, buy, if you buy from outsider, each one will cost 50 cents more. So for 5,000 units, it's going to be 2,500 more. And if you do my calculation, which I assume variable marketing price overhead cannot be avoided, and then make or buy from outsider will cost $2.50 more for each unit, and for 5,000 units, it's going to be $12,500 more. So first question answer. Okay. Next time we're gonna stick with. Oh, sorry about it. Then we're gonna stick with book answer, assuming book, or most people would like to follow the book, right? So that's the first thing we got. Now assume that 20% of fixed overhead can be avoided if the ingredients is purchased externally. Now let's do some calculation. Okay, it's gonna be a little bit different. And assuming 20% of fixed overhead can be avoided. So meaning that whatever remains will be 80%, right? And originally the fixed payment overhead was $6. So whatever remaining will be 80% because 20% will be avoided. So we are looking at 4.8. And here we do the same. And we see that after this, my answer and the book answer will vary. If you do the book believing that variable marketing overhead overhead can be avoided if they choose to buy externally instead of making, then it turns out after 20% of fixed plant overhead was avoided, it only costs $16.80 to buy the product cost compared to $17.50 to make one. So buying it, each one will save 70 cents. And for 5,000 units, totally it's going to save 3,500. So let's take a look at this one. It's a special order decision, basically whether to take or reject special order. Harrison Ford Company has been approached by a new customer with an offer to purchase 10,000 units of its model IJ4 at a price of $5 each. Now they buy a lot. Of course, there's a catch, cheaper. They want cheaper. The new customer is geographically separated from the company's other customers, and existing sales will not be affected. So, meaning that they won't have any. If this becomes a new customer, sometimes if you have a new customer has splash effects, and right, it may affect existing customers in the way that they are buying from you, and some other customers might stop buying from you because those two companies, however, are related to each other, or they buy from you, they will sell because they get it cheaper, they sell to your existing customers. So if you accept such special order, you're going to lose some customer. So here it states existing sales will never be affected. Harrison normally produces 75,000 units of IJ4 per year, but only plans to produce and sell 60,000 in the coming year. And why is it important? Meaning that Harrison can easily produce 75,000 with existing capacity, and this year they only produced 60,000. So to tell us at least they have 15,000 capacity left, which is more than the 10,000. So they can fulfill the order, special order, if they decide to take it with no other, too much other new costs required, or fixed costs, fixed expenses required. So normal sales price is 12 per unit. Man, that's a big discount. And the unit cost information for the normal blah, blah, is that. So direct material, direct labor, variable overhead, fixed overhead total. So for this one, it's actually a little bit different. Okay. So let's first talk about price. Let's first talk about price, because whatever you sell to other people at a normal rate doesn't matter here. As long as this project, in a sense, can bring you profits, given that Harris Ford Company still have capacity available, so maybe they should grab the opportunity, because no matter what you do, fixed overhead has been committed already, right? So that's something we have to keep in mind. So basically what we are trying to figure out is if Harrison Ford accepts a new order, whether it's gonna lose money or not lose money, right? So we know the how to put this. We know whatever the information for the existing business won't be affected. So let's take a look. So for special order, each one is $5, right? Each one is $5. What I put it. And again, we have to think about whether we can avoid some stuff or not. And a direct labor to material to make it, you can run away from it, 175. And a direct labor is 2.5. And the variable overhead is 1.5. And fixed overhead, I'll use the format of the whatever I got. So I was lazy, I guess, shouldn't be. And a fixed production overhead or fixed overhead was 3.25. Okay. So at a first glance, it seems to be really straightforward, right? We have the per unit cost is going to be, if the new special order is accepted, the per unit cost is going to be $9 and they want $5. So of course, you cannot do it. But let's take a look at each cost component and see if we are making the right calculation or not. First, we look at the direct material. Direct material, direct labor, their per unit variable cost. So as long as, no matter whose order it is for, a new order, old order, as long as you have production, you have those costs. Same story for variable overhead. So $1.75, $2.50, and $1.50, you cannot run away from it. The only thing is fixed overhead. Keep in mind, what is fixed overhead? Fixed overhead will be there no matter there's new order or not, right? Fixed overhead is going to be there. It's fixed. So it will happen every year, no matter if the special order is rejected or accepted. So if there's no difference between two scenarios, fixed overhead should not be in our calculation. So if we think this way, then we can still compare, right? If they accept the order, the income per unit is going to be, because the price will be $5, cost will be 75 cents, $5.75. For each unit, they will lose 75 cents. So they are talking about an order of 10,000 units. And if the total loss would be 3,500. So to answer this in short, if they take the order, the operating income will decrease and decrease by 3,500. So the company better not take the special order. Here, the result still leads to reject the special order, but we're going to think about it again, why we don't consider fixed overhead, because by definition, fixed overhead will be there no matter you accept or reject special order. So there's no difference on the two scenarios at all, and we shouldn't take them into the equation. Let's take a look at this one. This is keep or drop a product line problem. Segmental income statement for Hickory Company's 3 wooden floor products, strip, plank, and parquet, I guess. So the sales revenue we have for each 400,000 strip, plank, 200,000, 300,000 for parquet, and they have their individual variable expenses, and they have individual contribution margin, which is difference between sales revenue and variable expenses. And keep in mind, those things you cannot run away from. And there's direct fixed expenses, machine rents, supervision, and depreciation. Right? Depreciation related to the PPE. Machine rent is how much you pay for other people, no matter you use it or not. As you rent, you pay. Supervision regarding the employees, supervisors you hired. Hickory's management is deciding whether to keep or drop parquet, 300,000 parts. Right? Hickory's parquet flooring product line has a contribution margin of 50,000, which we see here, and all variable costs are relevant. All right, relevant because if you have it, if you drop it, it will be gone. If you keep it, those will be variable costs. relevant fixed costs associated with land includes 80% of the parquet machine's rent, meaning that if you really dissolve this land, you can return 80% of the machine. So 80% of rent will be avoided, and all the supervision salaries will be avoided too. Meanwhile, probably if you have a big factory they build, so depreciation, you cannot run away from it. Okay, you cannot run away from it. So, what is unique about this, right? So we can view this. In two ways. One way to see it is a more complicated way is to if we drop the parquet compared to we keep the parquet, what's gonna happen for the whole business? Which one generates higher income? If keeping the parquet generates higher income, then we keep it. If dropping generates higher, then we drop it. That's one. Or we can take another perspective. We can just look at if the parquet is gone, the going part, by dropping off the parquet, how much do we lose and how much do we gain? Then we can analyze just looking at the parquet without comparing with parquet and without the parquet. So let's take a look. Strip, blank, parquet, total. And we have sales, variable, expense, contribution margin, and those are direct fixed expenses. And we have rent, machine rent, supervision, and depreciation. All right, so here's a table we have. I'm gonna play some games on that. So no matter parquet, and we can see that at this moment, dropping parquet seems to be a good decision because if we just look at the second information, the parquet's financial information, and we know that parquet is generating losses of 45,000. So we've got two questions. Is it really generating losses of 45,000 every year? And if we drop parquet, would it make things worse or even better? So how do we do this? First, let's keep in mind this number, 115,000. This is with the parquet. With the parquet, how much net income, segment income, how much total income it is for the business. Remember, although the business drops parquet, they want to make sure for the whole business without parquet, they're gonna have more income. So we can compare this, right? We just look at this number, and let me just it's 115,000. That's a number with parquet. Keep everything as it is. After we drop parquet, what's gonna happen? There's no sales for sure, and if there's no variable stuff for sure, so those things can be avoided, right? And then for machine rent, what's gonna happen to machine rent? Relevant fixed costs associated with this line includes 80% of the machine rents. So they are relevant to this decision. If they don't change, they're irrelevant, right? The unchanging part is irrelevant. So 80%, so meaning there used to be, meaning that 20% is irrelevant. 20% rent will be kept because some people don't want it or it's for general users. So we will keep 20%, all right? So what is 20% of 50,000 machine rents? It's gonna be, meaning that the machine rents will be, after dropping, will be 10,000. And then all the supervisor salary will be dropped as well. They're all relevant because everybody needs to go, right? And depreciation, whole thing is irrelevant. Maybe it's a warehouse shared by every department. So no matter you drop or not, the warehouse depreciation is still there. So we can compare after dropping without. So without parquet, the net income will be 125,000. So we should drop parquet. We should drop parquet because dropping parquet will give you 10,000 more. So the next method is going to be a little bit less straightforward, but it involves less calculation, right? So now we are deciding whether what or not for parquet itself, how much can we save? How much more will it incur if we drop parquet by looking at the parquet just by itself, right? So if we drop parquet, we will not have the 300,000 revenue. We will not have the variable expense 250,000. So if you drop parquet from this two expense item side, it's gonna cause you lose net income, net contribution margin of 50,000. That's dropping. If you drop it, you're gonna have 50,000 less, right? However, you know that a machine, you can save some money because you will return some machine. How much before, if you keep parquet, you're gonna have to pay 50,000 rents. If you drop parquet, you have to pay only 20% of 50,000, which is 10,000. So by dropping parquet, you pay 40,000 less. That's the money you saved. So we put a positive sign. That's positive because of the money you saved. By dropping parquet from the machine rents, you're gonna pay 40,000 less, right? And then all the supervisor, if you keep parquet, you're gonna pay 20,000. But by dropping it, you save 20,000 because everybody you don't have to pay. So you make paying less like making money for a business. So you make 20,000, right? For depreciation, like I said, dropping, keeping, there's no difference. So making this decision that won't affect depreciation at all. So only these are relevant. So what's the total of these? 10,000, and we know dropping parquet, right? Dropping parquet costs you 50,000 less income contribution margin, but you will save costs 40,000 from rents, 20,000 from supervisor salary, supervision, which means net you will save 10,000. So dropping is a better decision. And that's all we have for today and for this book. Later, we're gonna maybe do some practice reviews and everything, and feel free to send me messages if you have questions. Thank you very much.